Welcome to The Explainer. Let's just jump right in today, because we've got a specialized strategic briefing tailored specifically for professional asset managers. We're going to deconstruct the exact mechanics of market fractures, and more importantly, we'll talk about how professional allocators absolutely must shift from passive, conventional diversification over to active, structural risk management.
Here's our roadmap for the briefing. First, the allocation trap. Second, the liquidity displacement mechanism. Third, historical market cycles. Fourth, 4 signals to watch. And finally, the structural advantage.
All right, part 1, the allocation trap. We're looking at conventional diversification versus structural positioning.
Let's start by painting a picture. It's the morning of September 15, 2008. We've got two investors operating with completely different frameworks. First, there's Daniel. Daniel relied on your standard 60-40 blend, right? Equities, corporate bonds, basically following all the conventional wisdom. But his portfolio takes a massive 64% drawdown from its peak. And because of some undisclosed leverage, he's forced to liquidate. Think about the math there for a second. A 64% loss means he needs a 175% gain literally just to break even. He didn't just lose money, he completely lost his optionality. Now let's look at Thomas. Thomas was an independent capital allocator focused on structural risk. Leading up to the crash, he shifted 40% of his portfolio into short-duration U.S. Treasury notes and held cash equivalents. When the dust settled, he stepped in and scooped up distressed commercial debt, trading at just 55 cents on the dollar. See, Thomas didn't magically guess the bottom. He used structural positioning to preserve his capital, which set him up for a massive asymmetric upside.
And that brings us to an absolutely crucial takeaway. Wealth does not disappear during a crisis. It relocates. It transfers from yield-chasing structures over to liquidity-preserving balance sheets. You know, people often think wealth just vaporizes into thin air during a crash, but it doesn't. It's just a mechanical migration of capital out of fragile, over-leveraged hands straight into resilient, prepared ones.
Moving on to Section 2, the liquidity displacement mechanism. Let's deconstruct the anatomy of a crisis.
What's really fascinating here is that market collapses, they aren't these unpredictable, random, black swans that catch everyone off guard. Actually, they're a highly mechanical, 4-phase feature of the financial system. We call this the liquidity displacement mechanism. It's built on the reality that financial systems are hierarchical. Capital flows upwards seeking yield when times are good, and it rushes downwards seeking safety when things contract. By tracking these 4 distinct phases sequentially, we can pinpoint exactly where we are in the broader cycle.
Phase 1 is the illusion of abundance. This kicks in when debt growth starts outpacing income growth. You've got lenders aggressively competing for yield, leverage is expanding everywhere, and risk becomes systematically underpriced. Asset prices are inflating, but it's driven by leverage, not actual productivity. Here's the key for risk management, though. Smart capital doesn't panic here. Instead, they quietly reduce their duration. They start building up those liquidity buffers while the rest of the crowd just blindly assumes the recent gains will last forever.
Then we slam into Phase 2, the credit fracture. This triggers the moment refinancing costs eclipse cash flow generation. Think about it. Debt is a fixed, non-negotiable obligation, but income fluctuates. When that gap gets too wide, defaults spike and lenders pull the plug. What was a perfectly functioning market suddenly turns into a frozen grid. The market doesn't plummet because fundamentals just completely vanished everywhere. It falls because a severe liquidity seizure forces margin calls. Assets get priced purely at their liquidation value, and correlation basically goes straight to 1.
Next is Phase 3, the policy bridge. Systemic collapse is, politically unacceptable, so central banks inevitably step in. They slash rates, pump in emergency liquidity, start buying assets. But make no mistake, this bridge buys time, not transformation. That artificial central bank liquidity ends up bifurcating the market. It heavily rewards primary dealers and senior secured structures. But the underlying suffocating debt burden, that stays totally intact. Productivity hasn't magically been fixed, so disciplined investors know better than to chase that initial rally. Finally, we land in Phase 4, structural repricing. This is the moment artificial liquidity hands the baton back to organic reallocation. Credit standards finally normalize, new refinancing cycles kick off, and assets settle at their new true equilibrium based on actual cash flows. This right here is where the big wealth consolidation happens. If you maintained your optionality and kept your liquidity through the worst of the vacuum, this is when you get to acquire premium assets at heavily discounted prices.
Section 3. Historical market cycles.
Let's validate this structural pattern.
Just to prove this isn't some quirky, one-off anomaly from 2008, let's zoom out and look at the empirical precedents over the past century. In 1929, the trigger was margin calls, causing a massive deflationary reset, where cash was king. In 1973, it was the OPEC embargo, sparking an inflationary displacement, sending capital running from fixed income into tangible assets. Fast forward to 2008, we had that massive liquidity vacuum rewarding short-duration government paper. And then 2020, we literally saw the entire cycle play out on fast forward because of the pandemic. The overarching point? The specific trigger changes every time, but the underlying structural displacement mechanism, it is completely identical.
All right, section 4. 4 signals to watch. This is your forward-looking dashboard.
So how do we actually operationalize this as fiduciaries? We rely on a forward-looking dashboard. Listen, trying to predict the exact future is a fool's errand. You don't need to be a psychic. You just need to watch these specific, measurable thresholds to see exactly where the stress is quietly building up. Let's break these down one by one.
First up is 450 basis points on the high yield to investment grade credit spread. Under normal conditions, this risk premium floats around 200 to 300 basis points. But when you see the ICE BOFA high yield index spread push past 450 basis points, that's your confirmation. It tells us that severe credit stress is aggressively forcing its way into the system. It's not a crystal ball for a crash, but is absolute confirmation of liquidity contraction. Next is the 50 basis point threshold on the SOFR OIS spread. This is a direct measure of stress in the funding markets. Usually it sits right around 0. If you see this spread persistently hanging above 50 basis points, that is a huge red flag. It's a direct precursor to displacement, telling us that the short-term funding markets are fundamentally glitching out.
Then we have the big one, $1.5 trillion. That is the colossal refinancing gap currently staring down the commercial real estate sector. When you take that massive maturity wall and combine it with national vacancy rates sitting over 12%, plus refinancing volumes plunging below 40% of scheduled maturations, that is profound structural stress. It clearly signals a massive delayed repricing coming for asset-backed credit.
Finally, keep a very close eye on central bank mechanics. Specifically, watch for a consistent reliance on primary dealer repo facilities combined with a slowing pace of balance sheet runoff. When primary dealers are constantly running to the Fed for liquidity, it means organic, private market funding is drying up. It's that simple.
Bringing us to Section 5, the structural advantage, the fiduciary mandate.
Let's pull this all together and talk about real-world outcomes. Let's check back in with Daniel and Thomas from 2008. Daniel technically survived the crisis. Sure, his portfolio nominally got back to even by 2014, but the unseen cost was devastating. He basically lost a whole decade of compounding wealth and had to work 7 extra years just to patch the holes in his portfolio. Thomas, though? By utilizing the structural advantage of prepared liquidity, his portfolio actually appreciated 210% by 2013. He didn't just survive the crash, he capitalized on it and retired early.
Look, the mechanism absolutely does not reward prediction. It rewards preparation. As professional asset managers, your fiduciary duty requires you to recognize when duration is turning into a liability. True risk management means you are building those liquidity buffers well before the vacuum is front-page news. Smart money always moves quietly, stepping out of long-duration risk and into short-duration instruments while everyone else is just blindly hoping for continuity.
Because here's the reality. Crises are not anomalies. You shouldn't fear them. They are quite literally a function of the system. They operate like pressure valves designed to reset unsustainable debt, reprice bloated assets, and clear out the excess. Internalizing that concept is the absolute bedrock of preserving institutional capital. You can't control the macroeconomic cycle, but you sure can align your portfolio with it.
So as we watch these corporate maturity walls creeping closer and we see credit standards tightening up, I want to leave you with one critical question about your own capital structure. Are you just positioned for continuity, kind of hoping the cycle holds together? Or are you truly prepared for displacement, ready to capture the wealth when it inevitably relocates? Understand the pattern, manage the structural risk, and protect your capital. Thanks for joining us on The Explainer.